Welcome to the Create More Value podcast, sponsored by Fortuna Advisors, the boutique shareholder value improvement advisory firm. Create More Value is a series of conversations with senior executives, board members, investors, and other experts that have overcome challenges to create exceptional value for their companies. There are many ways to drive value, so we cover a wide range of topics. I am the host, Greg Milano, founder and CEO of Fortuna Advisors, and I hope you enjoy the conversation as much as I did. I would like to welcome Professor Prof Srivastava. Thank you, Anup, for joining me on our Fortuna Advisors podcast, Create More Value.
Thank you for having me, Greg.
We're very pleased to be joined by Anup, who is one of the world's leading experts on how intangible assets affect business strategy, corporate financial performance, and stock market valuation, as well as how intangibles should affect corporate governance and executive compensation. His area of expertise is unbelievably vital in the modern economy, where intangible assets, such as technologies and brands, have overtaken physical assets as the largest slice of corporate resource allocation. His research highlights key elements disrupted by the progression of technology companies, replacing legacy asset-intensive companies, accelerating corporate demise, and emerging hypercompetition. This economic transformation changes the role of the board of directors, creates new auditing and financial reporting requirements, and fuels a growing need for highly skilled human capital. Anup brings vast corporate experience as a banker, consultant, and corporate executive in the East and West Coast cities of the United States and India. He has held senior executive positions with asset-intensive companies as well as knowledge-based startups and has seen the difference firsthand between the two types of companies. In 2018, Anup was awarded the Canada Research Chair, a highly prestigious award by the Government of Canada, and he is a professor at the Haskayne School of Business at the University of Calgary. So, Anup, let us start with a foundational question. How are modern companies different from legacy companies, and what are some of the accounting deficiencies that limit our ability to fully understand what companies are doing and how they are performing?
Yeah, so fundamentally, the knowledge companies follow a different business model. Let's start with what we already know. We know about physical intensive companies. Let's take the example of Ford. Ford uh, technically creates factories to produce cars. So it uses atoms and molecules to produce atoms and molecules. The key part of any modern corporation is you have to invest today and you reap the benefits later. So you buy land, buildings, you put up the factories, and then production process happens 10, 15, 20 odd years later. You buy raw material, you buy work in progress, you convert that into a car and you sell it later. So physical assets being transformed into physical assets. The fundamental difference between modern technology company and old technology companies like Dow Chemicals and Ford is that modern technology companies rely on knowledge and algorithms and soft assets to produce soft products. For example, Google uses algorithm and data to instantly produce services that are instantly produced and consumed. Facebook uses data and knowledge about customers to provide instantaneous services. So atoms and molecules producing atoms and molecules, knowledge producing knowledge. These are fundamentally different two fundamentally different business models.
So that's really interesting. So you've conducted considerable research on how firms spend money on intangibles, and what have you learned through this research?
We are all business students, and our business training is based on some principles of microeconomics. That is, if we use atoms and molecules, then we'll produce this much of revenues, and if we start producing disproportionate amount of revenues, then a competitor will walk in and will take the market share away. Similarly, if we are producing products, physical products, and if we start making disproportionate amount of profits, then somebody else will come and offer similar product and will eat our profits away. So we know that there is a movement of return on equity or return on assets towards industry means. When we talk about knowledge companies, those principles are defied. Uh, some laws of gravity, no longer apply. For example, think about Google. Ultimately, it was two smart engineers who spent little bit of time and energy to create an algorithm, which led to $1 trillion company. And just yesterday, I think it became $2 trillion company. So, how can you correlate the investments that they make to create a $2 trillion company. So in old world, if you created a land, building, factories, products, and given the market structure, you could predictably produce products and sell it. In the modern world, many of the business models rely on luck. They rely on serendipity. Ex ante, we do not know that if you are investing in 10 projects, how many of those projects will succeed, and if and by what amount any of those will succeed. So the characteristics of today's modern investments are that they are highly risky, but a few of them pay off. But those that pay off, they pay off like crazy. Um, Take Google's example, take Facebook's example. Mark Zuckerberg started this project in his dorm at Harvard, and it led to a $2 trillion company.
So actually, you talk about the value of these companies. The increasing importance on intangibles changes the way we look at company valuation. So when we think about large tech companies and how they're valued, it's different from the way we would value a coal company or Ford, making cars. What are the things that make it different? Maybe partially about how the accounting affects it, but also just in general
Oh
the
yeah.
characteristics, scalability and things like that.
So again, I think accounting is related to economics because accounting reflects the underlying economics. Let's start from what we already know. We create a factory, we capitalize the investments, we call it property, plant, and equipment. So we spend $10 million today. Benefits will come over 10 years. That's how when our plant will be used. So we capitalize it and we call it property, plant, and equipment. If we spend on inventory or raw material, we capitalize it and we call it an inventory account. And when it gets sold, we recognize an expenses. So the accounting principles are what we call as accrual accounting, that even it doesn't matter when you spend, you recognize expenses when you get the
Mhm.
benefits. Now let's move to intangible intensive world. When we are spending the dollar today, you do not know which portion of that dollar will pay off. So if you are making 10 $1 investments, which one will succeed and by how much? So most of the outlays, I'm going to use the word outlays, are expensed. So R&D, market development, software development, algorithm development, organizational strategy, customer acquisitions, all those things that create assets of modern technology companies are expensed right away. So you do not see them on the balance sheet. In fact, if you look at Apple's balance sheet, its market value, as we all know, is $3 trillion
Mhm.
dollars. And what do we see on the balance sheet? $50 billion. I'm talking about market book value of equity. 3 trillion versus 50 billion. There's a 60 is to
Mhm.
1 ratio. So what we see as assets, what we consider as assets for valuation, at least what investors consider as assets for valuation, are nowhere to be found in the balance sheet. When it comes to income statement, the outlays are not matched with the revenues, which means that notions of profit and profit margins become useless. So again, next time you look at balance sheet or income statement, be cautious of the fact that neither the value creating investments are present in the balance sheet, nor are the outlays matched to revenues. So profit and profit margins mean anything.
So I think you're probably aware in our financial measures that we use at my company, Fortuna Advisors, we make an adjustment to take R&D and capitalize it. We show it. Our default is to treat it like it has a 5-year life, but when we're working with a company, we sometimes make that longer or shorter. Um, but obviously, for accounting purposes, all that just gets expensed, as you were just describing. So, do you think that if the accounting rules called for that to be capitalized, just like the physical assets, do you think that would affect valuation or and performance measurement? Would it change anything if the accounting actually worked that way?
So, of course, the accounting will change. I'm not sure about
Hmm.
valuation. Now, I don't even know how investors figure out that information or what creates value, but the accounting numbers will change dramatically. In fact, I have a paper in management science which talks about intangible investments. It shows two things. First, it is the largest category of operating investments for US corporations. It is no longer property, plant, and equipment. It is intangibles investments. It is the largest category, so they cannot no longer be ignored. Number one. Number two, it's not just about R&D. Research and development is important. It has become one of the largest operating investments. But there are many soft investments that firm make. For example, customer acquisition, software development, organizational strategy, first mover advantage, uh, learning about the competitor, customer relationships, data security, things like that, which is not
Mhm.
strictly R&D, but it is. The caution that I will say is that, first of all, these numbers are not there on the financial statements. So unless, I mean, you have privy to some confidential information where you talk directly to the management, but for if you're analyzing public
Mhm.
companies, that that data is not provided. First, that data is not provided. Second, how to distinguish between what I will call as investment R&D versus maintenance R&D. Maintenance R&D simply is like running on a treadmill to
Mhm.
stand still, which is I'm doing just to keep up with competition. Otherwise, telecom companies 2G to 3G to 4G to 5G, otherwise I'll
Mhm.
be wiped out. Versus creating a new technology or a new product altogether, which is by itself, going to create value for me. So we have, I and my co-authors have done a lot of research, and we have published both academic papers as well as practitioner papers, where we have thought a lot about what portion should be investment and what portion should be what we call as
Mhm.
maintenance. And that differs by industry, it differs by firm life cycle. So, what you are doing is absolutely right. Of course, it changes the numbers. It changes the assessment of firm's profitability. It changes the numbers by which a division or a CEO or a scientist should be evaluated, um, and that's the right way to go.
Yeah, you make a whole series of really good points there. The one about it's not just what's in like some of what's in R&D is really investment, and some of it is really expense. And there's also other investment that's not in the R&D line, that's in other SG&A lines. Let's say from the outside, it's very hard to know that. From the inside, it's also hard to know. And one of the reasons I always like capitalizing R&D specifically, because I'm always worried about behavior, and we very often get involved in designing executive compensation, and it's really hard to manipulate that number because there are very tight rules around what's allowed to be called R&D and what can't be called R&D. When you start delving into other lines of the SG&A, there's so much more opportunity for somebody to game the system because it's not what's in the actual reporting. But I completely agree. Even I've done work with marketing companies, and brand building advertising should be treated as an investment, but a lot of more transaction oriented expense that just triggers a particular sale and doesn't have any impact on how somebody feels about the brand really should be expense. So you run into the same kind of thing. So that's really good. Let's actually turn our attention to. Oh, yeah,
So
great. Yeah,
can I just
yeah, yeah.
respond to that point? I think, being an accounting professor, I have some views on it, and I think the accounting is based on certain estimates and on the fact that we have to rely on managers or CEO to at least provide
Mm,
their assessment, their subjective assessments. So, for example, let's go back to capex. Capex, by definition, you have to distinguish between what is maintenance and what is
mhm,
investment. So, even if we think about capex, we treat it as one bucket. It is not one bucket. So, managers are making, when you sell something and you recognize revenue, you're making an estimate about what portion of receivables will be received. Okay, so you're providing
mhm,
for bad debt. So accounting by definition, again, even in capex, you have to estimate what is the useful life. There is scope for manipulation in everything. My question often about these things is: do we throw the baby out of bathwater? Okay, are we saying, okay, every dollar that a firm spends on R&D is all to be expensed, or every dollar that is spent on brand building is to be expensed because it's all maintenance? What I would rather like is at least get a feel of what managers
mhm,
believe, what portion of that is investment, rather than not have it. And you know, now the problem is that on one hand you say that it has scope for manipulation because they will try to capitalize it and like to show higher profits to increase their bonus. The flip side is that they will say, look, if my only metric is earnings, why should I spend on
mhm.
R&D? See, we think about one side of the problems, but it's a more complex and
Yeah.
multifaceted problem. And I think you're going the right way when you talk about your subjective assessment based on, again, firm's
Mhm,
business model, firm's life cycle, firm's industry, and what portion of that outlay should be capitalized. And in fact, often have a tendency to jump right into expenses. What about revenue line item itself? That is also wrong for modern technology companies, because there are multiple value creating events that do not appear anywhere in income
Mhm.
statement, and they do not require even a dollar of expense. For example, if a famous influencer endorses my product, or I get an FDA approval from stage 2 to stage 3, that's a big
Mhm.
news. It's neither on revenue side nor on the expense side. It just sort of bypasses the income statement
Mhm.
altogether. So these are the things that make our accounting rich, which should be contextualized and should be used for both for performance evaluation as well as for measurement.
Yeah, that's really good. A really good. I like that's a really good point. So when we're looking inside the company now, so we're not investors looking from the outside, but we're working to make decisions inside the company as management. What do you think are some of the most important financial measures that should be used?
I think I'm going to summarize a Harvard Business Review article
Okay.
I wrote and exactly how one should go about. First of all, a very good understanding of what creates revenues. And I'm going to focus on modern technology companies. Unlike they're creating a property plant and equipment to create
Mhm.
cars, they are creating some asset which is going to create a new market for their product. So start from total addressable market. Talk about what new market it will create, what kind of market share we will get, whether we'll work on what is the customer unit. Is it subscribers? Is it number of cars? Is it number of
Mhm.
properties for Airbnb? So start from there. What is the business model? How that market will translate into revenues? That's, I think, 60% of the energies should go into understanding that. Then work backwards and figure out what outlays are required to to maintain that kind of revenue generating units, which I will call as maintenance
Mhm.
expenses, or I will call as what we generally consider as variable costs in our physical world. Let's also consider what investment outlays are required to maintain the regenerative capacity. And the third is what I will call as one time costs. And one time costs are also of two types: one that are related to our past. So we were building a project, and we know it's an uncertain world. 7 out of 10 projects will go bad. What is it related to past, and what is it that we need to provide for future? For example, we'll have to close a line
Mhm.
of business, or we'll have to close a project. So from internal side, we need to have a very good understanding of what our business model is, what we are trying to target, which is what I will, going back to old terminology, the revenue line item, and then outlays into maintenance, investments, and one time items. Just focusing on these three will give a much better understanding of what creates value for the company, rather than simply looking at a gap based revenues minus expenses
Ah,
equals
yeah,
profits.
that's a great framework. I really like that. You in our prior conversation, you mentioned that you recently surveyed tech CFOs, and one of the things you mentioned I found very interesting. It was they budget on scientist time. Can you explain what they mean by that?
So traditionally, we are all finance students again, and we have been taught to think in terms of payback period, internal rate of return, and the most important mm, uh, metric that we are budgeting on is money, dollar, because we are spending a dollar. And what what we learned from surveying at least those large tech CFOs, tech company CFOs, was money is not a constraint for them. If they want to raise money, there is enough dry powder sitting out there, and they can raise money anytime. What is really holding them back from implementing their business plan is, I will call it quote unquote scientist time. So their biggest challenge is when to deploy, where to deploy, and when to pull back, because scientists, as we know, are extremely attached to different
Mhm.
projects, and all we are creating is generating real
Mhm.
options. And so we should know how long to continue to back that real option, when to pull back and redeploy it elsewhere. Money is not a constraint. The second thing, in fact, related to that, what we heard was, which surprised me, I'm an accounting professor and I teach valuation, is, I use worksheet based valuation where I project cash flows and discount it back, where I'm relying on revenues minus expenses, blah, 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 to come out with valuation. And I teach real option valuation, but only in at the
Mhm.
margin. What these folks told me was they're willing to walk away from $500 million NPV project to deploy the resources towards something that is a $5 billion or a $10 billion upside. So we are taught, be risk averse. $500 NPV project,
Mhm.
take it. They're saying we are willing to walk away from it, but will rather create something that has a bigger upside, uh, which which is contrary to the notion of real option valuation, which increases with the risk. So that was a very fascinating
Yeah,
conversation.
that's really interesting. So they're taking the chance of a really big upside rather than a more certain, much smaller upside. Interesting. I guess that fits very well with some of the research done on big, hairy, audacious goals, right? When you shoot for the stars, and you may or may not get it. Do you find that the people inside of companies, CFOs, and other people that you've met with, understand real options and how to think that way when making decisions?
So even at the academic or theoretical level, it's not so well developed because it's very difficult to
Hmm.
model it, but there is no other way. uh, Worksheet based valuation, which is based on, as against a fishbone diagram, something leads to something and then it potentially leads to something, the exploding fishbone diagram, at least understanding the scenarios. People are spending time on it. They do not have, of course, they need expert
Hmm.
advice on this. First, they need expert advice on what are the scenarios, what are the possibilities, how to appropriately weigh it, how to estimate the distributions, the probabilities, uh, and what sort of weighting should be attached to each path. Of course, you need experts. Not to say that firms have that, but they have increasingly started thinking
Hmm.
about it, because it's no longer the case that I build land and factory and I'll be able to produce car and I'll be able to make profits. That deterministic path, single linear worksheet based path versus a fishbone diagram, I'm going to spend on something and hopefully it will lead to something else, which hopefully will lead to
Hmm.
something else, requires a dramatically different thinking.
That's great. What's one of the topics I mentioned in the opening was executive compensation. These new world companies probably require some differences in how they think about executive compensation. What are some of the big things that are different?
So, as we all know, compensation is largely shifted to stock, uh, whether it's restricted stock or it's an option grant. Option grant is just a leveraged stock. Um, 70 to 80% is from
Mhm.
stock, but to the extent that it is related to firm performance, firms are using different parameters. I have a paper where I surprisingly found that even the so-called adjusted earnings numbers versus revenues, there is a shift towards revenues. So revenue being the value creator for the company, it's a winner takes all. If you and revenue is not revenue by itself, but revenue being a proxy for market power. Have I created a product where I'm walking towards winner
Mhm.
takes all? Because in this world, losers don't survive. There are no silver medal
Mhm.
winners. It's only gold medal winner. So revenue has become far far more important than than any measure of earnings. And then earnings, as we all know, most companies, almost nobody uses the net income number, US GAAP. But going to a non GAAP number, which is some adjusted EBITDA, um, that requires, a lot of efforts and complexity. But I think almost every firm, to the extent it uses earnings, it adjusts it based on their assessment of what should be removed from the bottom line number.
Right, right, good. And my last real question is: so some companies have a variety of business units, some of which are like old world companies, and some of which are new world companies. Is it possible or practical to manage such a mix of businesses, or is it too hard to have both mindsets at the same time?
First of all, for many companies, this is not a
Uh-huh.
choice. Uh, For a hotel company, they have to think about asset based properties and also think about Airbnb. um, so just to give an example. Now, if there is no choice, then the question is, how do we create a culture? How do we create a culture where on one hand we are focusing on what I'll call as efficiency, how we most efficiently utilize our assets to generate revenues, and how do we most efficiently produce profits out of, squeeze every single dollar of profits out
Mhm.
of those revenues. So that's one thing. On the other hand, you're talking about generating options, and it's a wild west. Now, these two cultures cannot coexist. Okay. As simple as that. You need small teams, you need innovation, you need risk taking culture versus focus on
Mhm.
efficiency. So, what in my experience, what I've seen is that typically they will have two different offices altogether and almost far removed. Here we have, uh, operating center, and we have innovation center, which is thinking about new ideas, which is far removed. People are paid on different
Mhm.
performance metrics. The people that are recruited for that division are different. You do some sort of acqui-hires where you're acquiring for the sake of hiring, getting talented people, ambitious people, and keep them as far away from. So, to answer your question, uh, is this happening? Of course, there is no
Mhm.
choice for many old companies because, on the other hand, it's not easy to manage these two cultures.
Yeah, that's great. Actually, there is one more thing I want to bring up. Something else you told me recently, which I found fascinating. I wanted to make sure kind of came out here. You said that having a CPA is more of a disqualification for becoming a tech company CFO. I don't know if you meant that seriously or if that was just like an illustration, but
No, it's we heard it. We heard it in our talk, and this came up at more than one place. And so we explored it. And in fact, there is another thing that we heard, that for our strategy meetings, we do not invite our
Mhm.
accountant. We say, Mr. Accountant or Miss Accountant, please stay away. Um, because what we were told was they are distracting us from what we consider as value
Mhm.
creation, because they are focusing on what they're focusing on compliances, they're focusing on gap reporting, they're focusing on how we can report assets and revenues minus expenses, net income number, based on, in fact, just yesterday I wrote a Harvard Business Review
Mhm.
article, which is on loss making companies. We need to distinguish between loss making companies that are because of real business reasons versus because of accounting
Mhm.
related reasons. So an accountant will say, no, we cannot report loss. A CPA who's been trained only to think in terms of US GAAP uh, and accounting conventions cannot think that R&D is an
Mhm.
investment, because R&D is an expense. Brand building or customer acquisition is an
Yeah.
investment because it is an expense. So this person is concerned about what we have to report, meet or beat earnings targets, versus something that really creates value. So a person, not to say that CPAs are not smart people or that they cannot create value, but if somebody is thinking hardcore in terms of conventional
Mhm.
reporting and what accounting, accounting is like tail wagging the dog, accounting driving the value creation, those people are not fit for
Mhm.
the roles which are creating value in the modern era.
I'm glad you explained that. That actually does make a lot of sense. So, um, I think that's about the amount of time that we have. We've been speaking with Professor Anup Srivastava. Thank you, Anup, for joining for this important conversation.
Thank you, Greg. It was great talking to you, and I hope we were able to develop some useful insights for our viewers.
Yes, thank you. You have been listening to Create More Value, sponsored by Fortuna Advisors, and I am your host, Greg Milano, founder and CEO of Fortuna Advisors. I hope you have enjoyed this episode. Fortuna Advisors helps companies with strategy, capital deployment, business management, corporate culture, and incentive compensation, all aimed at driving top quartile total shareholder return and the equivalent for private companies. To learn more, contact us at info@fortuna-advisors.com.